Fueling worries around the world. With the price of oil now below $30 a barrel, the industry is today in its deepest downturn since the 1990s. So what's behind the fall? And why is it bad news for you, the consumer? This is Inside Story. Hello and welcome to the programme with me, Peter Dobbie. Now, with too much global supply and the lowest price in nearly 20 years, there is anxiety about a possible oil market meltdown. One of the three main benchmarks for oil, the Brent Global Index, just dropped below $30 a barrel for a second time in less than a week. US crude prices also fell below $30 on Tuesday before settling down, but only for a bit. While most major oil companies are slashing their budgets and jobs too, some of the biggest oil companies, like the Saudi Aramco Corporation, have not cut back on production. Some OPEC states, such as Iran and Iraq, are looking to increase production. In the past year, the price of a barrel of oil has fallen by more than 50%. The highest price in the last 12 months was $110 a barrel. Some investment bankers are warning that oil could crash to $10 a barrel. Yes, $10 for a barrel of oil. OK, let's bring in our three guests now. Joining us from London, Cornelia, Meyer, CEO of Meyer Resource. That's a macroeconomic and energy policy advisory body. In Lagos, Bismarck Rawani, Managing Director of the Financial Derivatives Company. Also in London for us today, Mamdouh Salameh, International Oil Economist and Consultant. Welcome to Inside Story. Cornelia, turning to you first. Could anyone have predicted where the oil price was going to go and to the point where it's gone to $30 a barrel?
Well, I think for about 6 months or so, we were starting to get very increasingly worried. And certainly when last December at the OPEC meeting, they failed to have a production ceiling in place for the first time ever. And the Chinese demand, the Chinese economic woes came in, and nobody was growing as much as we thought they were growing. Revisions downward and downward, downward for the macroeconomic growth of the world economy. We were starting to get concerned. And everybody's pumping whatever they can pump. And it's not met by sufficient consumption, so we knew that the situation was dire. We probably wouldn't have thought that it was going back down to 30 half a year ago, but I guess about 2 months ago or so, it was a little bit of a cliffhanger, and we thought it just might get there.
Bismarck, people are talking as well now, today, realistically, about $10 a barrel. Could that really happen?
No, not possible, because economies produce where marginal cost equals marginal revenue. The marginal cost of an average barrel today in Nigeria is about $25, anything between $20 and $25. In Saudi Arabia, maybe about $7 or $8. In the shale producing areas, about $40. So to go down to 10, it's not possible. But basically, we're talking about averages. The average forecast for this year, taken all the way to the year end, comes out at about almost $40 a barrel. So we expect that there will be some recovery, not soon. There's going to be a sustained era of low prices all the way till around May or June, and then before it goes up, but definitely not under 10. The Nigerian government announced this afternoon that its new benchmark price is $27 a barrel, which is another acceptance of that's a reality check. It came down from $38 to $27 a barrel.
Mamdouh, if what we're talking about here is a reality check, if we're at 30 a barrel and it can't go to 10, at what point will it stop sliding?
Well, you cannot tell how low the oil price can go, because the reason for that steep decline is still there. The reason is the glut in the market, which has been caused not by US or by American shale oil, as it has been said before. It has been caused by OPEC members producing 2.2 million barrels above their production ceiling. They have agreed a production ceiling of 30 million barrels a day, and they are producing 32.2. If you take the 2.2 million barrels and they abide by their production quotas, you will see the price jumping within a few days into $60 or $70. And I might add as well that the fundamentals of the global oil market are positive. Despite some worry about China, the Chinese economy is still growing at 6%, and it is far, far bigger, many times, than it was in the 90s when it was growing at 10%, and there is increasing demand of oil from them. If you look at the biggest economy in the world, the United States, it's growing. The third biggest economy, India, is growing very fast. The Asia-Pacific region is growing very fast. And the second fundamental is that the energy agency in Paris, the international agency in Paris, IEA, says that this year global demand for oil will grow by 1.5 million barrels a day. If you take these fundamentals, they are positive.
Okay.
So what is causing this steep decline? It is politics and overproduction by OPEC members.
Cornelia, do we have to make allowances here? Our other two contributors in Lagos and London, they were talking about shale there. In North America, if you're going to make money on extracting shale, i.e. if the economy is going to do well, you've got to take it out at between $60 and $80 a barrel. If it's coming out to be sold at $30 a barrel, is there a point where the taking the stuff out the ground is not viable?
Well, it's when we look at it, the $60, that was probably true 2 years ago. It's amazing how much the shale producers have actually been able to become more efficient. But what is happening in the shale space is that you have a lot of small companies that are highly, highly levered. And I think last year we saw more bankruptcies in the oil and gas space of these small companies than we've never seen as many since the Great Depression. So you will see some of them going out of business and other companies buying them up, and you will see this shale space acting very differently because bigger companies are coming in. And yes, they need higher oil. They need a higher oil price, but they have the last year, about month on month, about 3% of increased productivity. So the shale space is getting more efficient. But it's a very bad. It's in trouble, and we saw that BHP Billiton today wrote off nearly $5 billion on its shale assets in the US. So the shale space is hurting. That is right. But the thing is, it will ramp up quickly again when the going gets better again.
Bismarck, explain one thing for me from your vantage point in Nigeria, such a big, big producer of the black stuff. Fuel costs in America going down, fuel costs where I am in Doha today going up by 30%. Fuel costs in Dubai, not a million miles away from here, going down. It was 2 riyals, it's down to 1 riyal, something like that. Fuel prices in Europe, pretty standard, pretty steady. Why is there that discrepancy between point number one, what we have to pay, and point number two, why is a lower fuel price not fed on to us as consumers?
Well, there's the structure of the market and structure of the economy. The economies that you've talked about where prices are going down are more perfect markets. And you take countries like Nigeria and Doha, you find that those are imperfect markets there are barriers to entry and all sorts of structural defects. As we go along and the price of oil gets to a point where the cost per barrel and cost per liter in all of these countries become lower, in fact, in some countries lower than water right now, you will find that they will have to adjust their prices. But it's not just the price of petroleum products that needs to be adjusted. The entire economic structure of these countries are going to be adjusted. For example, in Nigeria, subsidies on the exchange rate and subsidies on the price of petroleum are being addressed at the same time, right? And so you're going to see
Can
that...
I add something?
Yes,
Yeah?
Cornelia, please do come in.
But what I would like to add here is it's also, we have seen that some countries that have given subsidies are getting rid of the subsidies, so the fuel price will go up because they get rid of the subsidies, and that's actually a good thing. The other thing, India has gotten rid of subsidies, Indonesia has gotten rid of some subsidies, also in the Gulf, in the GCC, they're starting to charge what the actual price is, which is usually a good thing. You should pay for what something is worth. Then you look at Europe, there is so much taxation. You know, there's about 3/4 or more of every barrel you consume is tax. So the elasticity towards the oil price is lower. And in the US, there's not that much tax, so the feed-through of the price will be faster.
Mamdouh Salameh in London, picking up on that point of elasticity.
Yeah.
If we apply that elasticity to a fiscal equation, in Australia, that equation that leads to fuel getting into Australia or being consumed in Australia at the moment, for example, it's not costing Qantas very much to fuel its planes. They're saving money on their fuel bill because their prices have actually gone down. However, if I want to fly to Sydney or Canberra from Doha tomorrow morning, my ticket on Qantas will still cost me the same amount of money. Is that just a decision taken by the management?
Of course, but let me point out before that, in the GCC countries, they started removing the subsidies gradually. Even Saudi Arabia has decided to raise fuel prices and water and electricity by 60% this year as a way of removing the subsidies. And the subsidies should have been removed long time ago, but now under the impact of lower revenue from oil and lower oil prices, they started to address that issue. Now, if you look at Europe, for instance, the price of crude oil has gone worldwide gone down by more than 70%, while the prices of gasoline and diesel in the market, as I know in the United Kingdom, has not gone by more than 25%. Why this discrepancy? It is because the government wants to keep the biggest amount as a tax for the treasury. And of course, although people are benefiting a bit from a reduction of gasoline and diesel, but the global economy is hurting. And when the global economy, you have to look at the bigger picture, whether in Australia or the Gulf or in America. If the global economy is hurting, and it's hurting very much now from these steeply declining oil prices. So that's the gist of the issue, and that's what has to be addressed. Where do we go from here? What will happen to the oil price? There is one answer, and the answer is OPEC has to cut its production by 2.2, prompted by Saudi Arabia. Saudi Arabia is instrumental in flooding the market. They are following an oil strategy which has failed in the 1980s under Sheikh Yamani, when he flooded the global oil market by 10 million barrels a day, to find that the price has collapsed to $10 a barrel, and he had to withdraw that policy. We have to learn from history. This same policy is being followed now by Saudi Arabia and forcing OPEC not to cut production. The only way is Saudi Arabia has to cut production, has to agree to OPEC cutting production. The Saudi economy, which is the biggest in the Arab world, is hurting too.
Okay, Mamdouh, I'm going to interrupt you for a second because I do want to get onto that idea of the global repercussions of this, and you're basically saying we have to know where we've come from to know where we're going to. So take a look at what's happened to the oil price over the past generation. Now, we'll start 1990. Saddam Hussein gets Kuwait into his crosshairs. He crosses the border, of course, late 1990, November, December 1990. He invades Kuwait. The rest of the world goes into a bit of a panic, so the oil price spikes. Fast forward, global meltdown, 07 into 08. We were all spending far too much money on credit cards, mortgages, and it was all borrowed money offset against borrowed money. The oil price spiked and then came down. Fast forward again to about halfway through 2015. You can see there just where the blue line begins to dip to the point where we are today. Let's put that in context. Cornelia, coming back to you first, if that's the trajectory of the past, 25 years or so, is it possible to predict what's going to happen over the coming 3 or 4 years? Because some people are saying, to pick up on that point that Mamdouh was making, this could cost $300 billion. And if it does cost that amount of money, if this carries on going and the Saudis don't listen to the other members of OPEC in 6 months or a year, that would have huge repercussions.
I have to say two things to that. First, very quickly, in defense of Saudi Arabia, if Saudi cuts production, and everybody else keeps on merrily producing, which they did in 2008, they're losing market share. So right now, it's not just an OPEC play anymore. Non-OPEC members should have to cooperate as well. So everybody's worried about their market share, which is why Russia is producing as much as they can, Saudi is producing much as they can. So we have a fight for market share, first of all. I want just to put that on the record. Secondly, what I think is important to see now is when you look at how much capex has been cut by big oil companies. Last year, 20%, more than 200 billion. You saw this year alone, BP firing 4,000 people. Everybody's cutting their capex. It's getting into cutting OPEX as well. You look at how the oil field service companies, very important, are cannibalizing their equipment because it's just expensive to retrofit things. So you just take some parts from idle laying equipment. So when we then need to, these oil fields are finite. You need to re-inject. You need to work them in order to stimulate them. You need to go over and drill for new oil fields. So as we are sort of tapering off, it's not a light switch, it's an ultra-long cycle business. Conventional oil, a dollar invested today will produce me a barrel in 3 to 10 years. So as production comes off, if we are not investing, what really keeps me awake at night is not the very low oil price now. It is 3 years from now, when we need more production. Where will it come from? Because we will be woefully underinvested by then. And then we could see oil prices do the reverse and spike, which is essentially what we have seen, sort of in 2000, from 2004 to about 2008. Remember when it went to nearly $150? So that is another thing. This is highly volatile and very long cycle.
Bismarck, if it's highly volatile and yet a long cycle that we're talking about, in the 3 years that Cornelia was talking about there, I mean, your country is one of a list of countries, Venezuela, Iran, Ecuador, Brazil and Russia, all suffering now because of this, because some of the economic fundamentals are highly questionable. I mean, 250,000 people across the industry being laid off. The consequences of that could be what, do you think?
No, I agree with what Cornelia is saying. She said that the structure of the industry and the lack of investment is affecting output and affects future output because there's a natural attrition of wealth. However, it's an oligopoly, and the control of the swing producer, which is Saudi Arabia, has been waning over time. So Saudi Arabia's role as a price leader is being reduced gradually, and therefore, and Saudi Arabia's needs as a country, because both for political and social and economic reasons, their needs are more, so they can't afford to actually allow the price and the revenues to drop. However, they are aware that in a price war, the only person that suffers are the producers. So there is an issue, an alignment between how much has to be invested. Don't forget, Aramco is going for an IPO. How much, at what price, what kind of return are you going to expect on these wells? And what is the structure of the market? It is moving more from an oligopoly more towards imperfect competition, which means that the producer, the bargaining power of all the producers is getting weaker. So there's a fundamental and structural shift. So if you look at 1997, 2008, and 2015, what has happened is that the cartel has become weaker, and the role of the price leader has become even more tenuous. And so there's a fundamental shift combined, right, by this reduction in investment and change in technology in the industry.
Mamdouh, picking up on that idea of investment or self-investment, if you live, work or save in US dollars, is there potentially a huge problem around the corner? Because the Qatari rial, where I am, is pegged to the US dollar. The Saudi currency is pegged to the US dollar, 3.64 and 3.75. If that pegged relationship begins to suffer, does that mean that Americans will be able to spend less money or get less stuff for every dollar that they spend?
Well, the GCC countries as a whole, with Saudi Arabia as the top, all are pegged to the dollar virtually. However, Saudi Arabia as the biggest economy in the Arab world and in the Arab Gulf has its Saudi riyal suffering now. There is a huge pressure on the Saudi riyal because of the damage to the Saudi economy by low oil prices and reduction in their revenue. There is talk that the Saudi riyal could be floated or devalued. Either way, it has to separate from the dollar. And anyway, this pegging to the dollar dates back to 1973 when the petrodollar was introduced. And the petrodollar, as you know, is the one which oil is priced and sold worldwide, and it affords a great benefit to the United States because every barrel sold, there is demand for American dollar for it. But before finishing this, I would like to come back to the point the lady made. When you talk about defending your share in the market, the Saudi policy of defending their share is wrong, false on economic grounds, and I tell you why.
Okay.
If every producer in the world starts defending its share, it exacerbates the glut, and all of them will be losers. And
Mamdouh,
furthermore,
I'm going to stop you there because I want to spend the last 2 minutes talking to our other guest about a point that you've already made very strongly, and I'm very grateful for that. Cornelia, if we're plotting a course from problem to solution here, is Saudi changing its policy the only way to get the price back up again so the markets will feel confident, the markets will climb again? We saw what was going on in the East Asian markets today, looking very, very negative at the end of the trading week. I mean, is that the only solution to this?
Well, first of all, it will be very difficult. And where you will see the Saudis coming from is when in 2008, OPEC went down very drastically with production in the aftermath of the financial crisis. What you saw is everybody went up very quickly, and the Saudis were, so to say, left holding the baby. So they will be reluctant to engage in that policy, and it's not just Saudi Arabia; it's Russia as well. So they're all doing it. So essentially, what we would need is a bargaining thing where all the big producers are saying, okay, we're going down. But I think it will work itself through the market. When you look at it, as some of the commentators said very rightly, we have reasonably good demand. As we see this attrition coming from lack of underinvestment, it will go up again. I would foresee that this will work itself out. We will see it will be tough until the middle of this year. After that, I think we will see it. We will see the price picking up again.
Okay.
And to 2017, it's going to go up quite a bit.
Okay, very, very briefly, Bismarck, there's no more spare capacity in the system to act as a buffer if there's another event, another war in the Middle East, say, that would make the markets twitchy. So, in a sentence, is this all down to the Saudis to loosen the stays of how they do what they do?
No, three things. Saudi Arabia can call for a meeting so that we can agree on production and price quotas again. Secondly, what happens to Iran when the sanctions are lifted and how much are they going to pump? And thirdly, the fundamental question about investing in the industry. All those three things have to be addressed. But short run, volatility between January, February, and March. I think that Saudi Arabia, there will be a meeting in March of OPEC, whether we like it or not. And then they will come to some kind of agreement, very tenuous agreement. It won't hold that much, but by June, it become clear that this is mutually assured destruction for everybody, and the prices begin to pick up again. At the same time, people begin to invest even though marginally, based on incentives granted by host countries to ensure that the long-term trajectory for prices remains stable, but nowhere near $90 or $100 that we saw in the last 2 years.
Okay, we have to leave it there. Thanks to all our guests today, Cornelia, Meyer, Bismarck Rouhani and Mamdouh Salameh. Now, the debate continues on our Facebook page, or you can tweet us, AJ Inside Story, or talk to me on Twitter. You'll find me under AJ Dobbs. You can leave your comments on the programme's page of our website, aljazeera.com. From me, Peter Dobbie, and the team here in Doha, thanks for watching. We're back at the usual times tomorrow. We'll see you then. Bye-bye for now.